Hello, and welcome to the East Africa Business Podcast. I'm Sam Floy, and I'm here on the continent to learn about the emerging business scene. I'll be interviewing startups, investors, and organisations who are all playing their part in helping the region develop and grow. And in doing this podcast, I'll be sharing with you the things that I learn along the way. Interest rates in Uganda, and indeed the whole East Africa region, are, by Western standards, very high. A small business looking for a short-term loan from a bank will be expected to pay in the region of 10% interest per month. And in an economy where payment is often made upon delivery, this causes problems in terms of getting access to working capital. In this episode, Bakka and I discuss Patasente, the platform he has started to essentially crowdfund credit agreements for small businesses so that they can raise the funds to take on new contracts that come in and grow their business. It's a really interesting interview that we have, and so I hope you enjoy. So I'm here today with Bakka. Bakka, welcome to the show.
Thank you, Sam.
So we're here today to talk about Patasente. I was wondering if you, just to get us started, could you tell us a bit about what it is and how you got into it?
Sounds good. My name is George Bakka. I'm an entrepreneur who is very passionate about what finance can do to develop entrepreneurship and economies in Africa. So we're working on a new venture called Patasente, which is a credit marketplace that allows people to either guarantee or lend growing businesses in East Africa. So typically entrepreneurs get working capital loans, and investors finance those loans by buying interest-bearing promissory notes. A typical example could be a company run by an entrepreneur called Dixon, and he has got a contract to supply maize to a school, and he has gotten a local purchase order. So they bring us that order, then we convert how much they need at a specific interest rate, list it on the Patasente marketplace, and investors buy. So if it was, say, $10,000 contract needing $5,000, then 10 investors can buy promissory notes of, say, $500 each. You get the entire $5,000, you lend it to Dixon, he supplies, he gets paid, and everybody gets paid.
I see. So is it kind of like a crowdfunding platform?
Yeah, you could think of actually that's the kind of concept around it, right? You're using crowdfunding, not necessarily to just grant money out, but actually to lend money and get money back. Yeah.
And so who are the typical recipients? Who are the people who are asking for the funding?
Yeah, so currently the typical focus market is enterprises, micro to a small extent, but small and medium enterprises. With 2+ employees, they've been in business for at least a year. They've averaged at least $5,000 in revenue in annual turnover. And where we feel that our financing has a potential to kind of at least allow them to double or triple those particular revenues. So typically, those are companies which are well structured and they have capacity to go outside, get a client, and get an order. But their only limitation is the capital. Yeah,
I see. So we're talking about established businesses. They've had a few orders. They've now got. Usually, is it like they've got a bigger order, and they're like, right, we need some money to actually finance this.
Absolutely.
So, what do they do at the moment without you? Like, what's the alternatives that they have?
Yeah. So, alternative is actually two things. One is either to avoid going for big orders, because you actually know I don't have the financing to do it. And especially most clients don't want to give any business they don't suppose has the capacity to deliver, right? So one alternative is for the enterprise to just avoid that particular market and say, we shan't serve formal bodies with payment times of 30, 60, 90 days. We shall keep the cash market, where growth is actually very limited, right? So one is to actually just leave, which kind of creates that kind of stagnancy in so many entrepreneurs and sometimes actually some collapse. The second alternative is to go to money lenders, right? Money lenders who are basically charging high interest rates. So you find an entrepreneur being charged up to the maximum of 20% a month.
Per month?
Yep.
So over So over the year, that's them paying 2 or 3 times as much.
If he's a little bit considerate, then he may do it 10% a month. Otherwise, it ranges between 10 and 20. But also that doesn't take away the requirements. You still have to have collateral, fixed assets. So most of them, I think with money lenders, you have the advantage of that. If you have the fixed asset, they'll give you the money, but the interest rates are quite high, right? The other alternative is to go to the banks, traditional banks, which require to have the fixed assets, have guarantors, the time is a little bit longer, with the interest rates a little bit lower, right? So there is a mismatch between, you find a partner who has got the contract but doesn't have collateral, or doesn't have guarantors, doesn't have any credit history whatsoever that banks can base on. So then financing becomes hard, right? So you think about the cost of capital, but also the time of acquiring it and the ease of acquiring it. So I think that's where our market is. Yeah.
See. And so do you not require collateral from the people who are raising money?
Typically not. The traditional sense of thinking about it, no. But of course, in a financial perspective, we kind of collateralize those loans. But what we basically base on mostly is the contract that has someone brought us, a local purchase order. And we look at the validity of that. Who delivered it to you? Do you have capacity to deliver on it? And what's the payment time? Once we feel the variables are a little bit lower, then we shall advance capital to you. Yeah.
So the business opportunity that you have identified is that the existing money lenders or the existing banks aren't willing to give favourable terms based on these contracts.
Absolutely, yeah.
And why do you think they've not picked up on that opportunity?
I think it has so many moving parts, because then you've got to understand the entrepreneur who is bringing you that local purchase order for financing. So typically, if a bank, if you haven't had long history with it, then of course there are so many tentacles. Your risk antennas are far higher, right? But then also you have to have a deep understanding of who gave them the contract, what do they need to do to deliver on it, how do you minimize contract risk. So there's so many moving parts, in terms of understanding the particular industry and being able to monitor the movement of that product from the supplier to the client, and ensure actually it's the quality that actually people want, right? So it's just not giving finance, it's basically going into and observing that supply chain and ensuring that the risks that could otherwise affect the movement of that product are kind of reduced. Because if you give an LPO loan, then the kind of collateral to it is the movable asset.
It's an LPO loan?
Yeah.
What's that mean?
Local purchase order financing, right? So we do basically that. Then in typical points also we do factoring of invoices, right? So you've delivered a product to a client, say you've supplied a school, they're paying in 90 days, but you need cash now. So typically you still come to us, we shall discount that invoice, pay you cash, and then basically go do business. So it's a market which in developed economies, because the credit scoring, credit registry are really well structured, then banks, I think in Europe and the US, can easily do that. But in Uganda, not really, right? So typically we're actually building that data from scratch to allow us to make better lending decisions.
I see. So what are some of the ways that you assess creditworthiness in a funder?
So two things. For us, we basically look, like I said, we look at the validity of the contract or the local purchase order you've brought.
What are some of the signs of a valid contract versus one that you wouldn't want to give money on?
Yeah, that's a good one. Right. So of course we have a few top companies within Uganda: MTN, Nile Breweries, a few government agencies, UCC, international agents, World Food Program, UNHCR, NGOs, which you practically know that by the time they put out a local purchase order, they have allocated funds for that. So we do a little bit of research on that, talk to their suppliers, and actually, find out what's their payment periods look like, if they pay on time and stuff. So if all suppliers to a specific company are talking good about it, then to a certain level, you're kind of much more confident that this is a company whose LPO will actually be paid in time. So if other suppliers are talking bad about a specific company and you have an LPO on your desk, then typically that shows that, that's not a company you want to bank on. because you're giving credit not necessarily based on the entrepreneur, but also on the validity of what you gave them this LPO. Then second, of course, we shall look at the entrepreneur themselves, right? Do they have experience in the industry they are in? Because once we are clear on whoever gave you the contract, then you're basically assessing you. Do you have capacity to deliver what they want? Because if you don't deliver what they want to pay you, which makes our money much more risky. So we want to also know, speak to you and say, okay, who have you done work before? Then we should talk to those who have done work before with to ensure that you've done good quality work and you actually know what you're doing. So a bad entrepreneur, a bad loan would be someone who hasn't done something in that specific industry and is now looking for a contract financing in a contract that he's just getting into, right? So we shouldn't do that. So kind of like from knowing what is good, then you know what's bad, because it's the opposite of that. Yeah. So once we are sure about those moving parts, then we want to say, okay, in worst case scenario, what are we financing? Are we financing perishable goods that in case you deliver them in the market and you don't sell, they will rot? Yeah, you may be good, you may be whatever, but are we financing assets which can be resellable? So this kind of assess the moving asset piece of it. That is it something which has resale value in the market, just in case things don't go as planned. And once we are sure about that, then we shall basically say, okay, let's discuss this particular one.
So that sounds quite quite a lot of work. But let's say I'm what do you call the two sides of the marketplace? What do you call them, a customer or?
Yeah, so we have the lender and the borrower.
The lenders and borrowers. So for the borrowers, and then you also have the people issuing the LPO.
Yeah, absolutely.
So let's say I'm a borrower.
Yeah.
And I come to you. This is the first time you see me. And I say, look, I've got this contract from this LPO, which is not one of these famous companies. Roughly, how long will it be until I start to see money?
Yeah, so currently we have an internal list of companies we trust that most suppliers have spoken good about. If you brought us an LPO from any of those companies, we shan't take lots of time to say yes, right? But if you bring us...
Are we talking a few hours?
A few hours.
Okay, a few hours.
A few hours, right? But then, of course, if it's not on that list, then that means new data. I think in the future we shall become much better because we are collecting data on each of the LPOs we are getting and collecting supply information on all the different players in the market to allow us to make faster decisions on even companies we haven't seen. But as of now, we are still restricted to a few, right? So typically, it takes actually a few hours, right, to actually just say, okay, who is delivering the contract, then you who brought it, which work have you done? We should make a few calls, put a few people on the ground to kind of do some kind of observation. So our kind of return time currently is between 24 to 48 hours. So we because we've done a little bit of groundwork already, so now normally it's now just validity of contract, capacity to deliver, whatever moving pieces.
Okay, so if I'm a new borrower, I come to you, you're saying tomorrow you send people out on the ground to what sort of questions are you asking?
So typically, if we are assessing the company, the borrower, then we're going to be asking them, what kind of work have you done before? Do they appreciate it? Will they recommend it to someone else? So to the certain level, you're pretending to be another buyer.
I see. So do you sort of phone up and pretend to be?
Absolutely.
Oh, right. do you use a fake name?
In some cases.
In some cases. Yeah. All right. So you go and you sort of create your alter ego and you go and make these phone calls, and then you come back and you think, okay, I now have. Is it black and white? Is it yes, no, or is there some sort of grey area between you're kind of a little bit happy, or are there some instances where you'll only give them part of the money? How's the process?
Yeah, currently we're not able to do a yes or no issue. It's either yes or no, right? Because it's you're financing a contract, and you also have time limitations, right? So if we are saying yes, we shall say yes, and then we shall basically look at, okay, when do you need the money? Right? So if you bring us LPO today, you need the money on Friday, then we know, okay, we're going to list this loan on the marketplace, and then investors or lenders have 4 days to kind of finance it. So we try to keep our funnel quite big from the start and just try to get 100 quality borrowers coming through the system. But of course, we know the limitations of what we're doing right now. That in terms of we have little data we are basing on right now that we want to expand consistently.
And so, what are the payment terms for the borrower? So how much are they going to have to be paying back?
Yeah, so for the SME market, folks who bring us local purchase orders, typically the payment term is a lump sum because we are financing a local purchase order to supply maize or commodity to a school. You're going to be paid in lump sum, pay us back in lump sum. So in ordinance, with the payment period, so if it's 30 days, so once they pay in 30 days, bring back the money.
Cool. So let's say the LPO is for $5,000.
Yeah.
How much are they paying? Do they just pay back $5,000, or what's the interest?
Because you have a certain interest. It ranges between 5 to 10% max.
5 to 10% of the lump sum.
Yeah, of the lump sum. Right. So if typically our loans are people pay within 90 days. So we take the worst case scenario that they are going to pay you after 3 months. And then you basically put the rate to it, and investors basically put it out to the market.
And I'm interested, so let's talk a bit about the lending side of the marketplace. So who is your typical lender?
So a typical lender for us is either a high net worth person or a middle class person who is earning slightly above $500 a year, and therefore have a little bit of cash they can afford to put away, right? So, and why we did that is because we found that if a bank is not willing to lend to these kind of people because of everything, that means they're saying it's super risky, right? We can't bet our money on those risky people. But also with investment, investors are people who are willing to take risks. Right? So for us, ours was which class of people are willing to take a certain level of risk they would be comfortable with. Because when we are giving a loan based on the assumption that the buyer is going to pay this entrepreneur, and if he doesn't, that means that's a bad loan, right? So what kind of people are willing to take what kind of? So we think it's people who have earned a little bit of money, they have a little bit of cash that's kind of standing there, they want to invest, they're willing to a little bit take a certain level of risk. Then what we tell them is that we're going to help you diversify that risk. So you're going to buy promissory notes from 20 loans at once. It means the chance of loss of that money is 1/20.
I see. So it's not that I'm a lender and I say I want to fund this specific maize contract. Do I give my money? I give my money to you, and then you are kind of in charge of which contracts, which LPOs it goes to.
So we list all the loans. Typically, we list them like you find bread on the supermarket, right? So the same way you go to an online shop and try to shop clothes, so we list them like that, right? They are coded, of course, loan codes, but you kind of see the purpose of the loan. This is to finance maize, this is to finance a car, this is to finance an asset, this is to finance air conditioners, this is to finance electronics, this is to finance commodity. So kind of different loan purposes, right? So what we typically tell our lenders is look at how much they need, what's the return ratio, what's the risk associated with that national loan, because we publish that information publicly. Then you typically put money in how many loans you choose, right? So we try to encourage folks to put in so many loans at the same time. So once the loan is fully bought out, once all the promissory notes are bought out, then that loan is fully funded, funds are advanced to the entrepreneur.
And where do you publish? Is this on a website?
Yeah, so we've been testing it out physically for the last 12 months. And now we're basically putting it on the website and the mobile application. I think that's where much of it is coming exciting, because we didn't want to go to the website and the mobile app before we are sure that this actually works. Because the tendency, I think, for most entrepreneurs is to start with the delivery piece without figuring out actually what's their business. So right now, we're developing a website, and people will actually be able to go online and either, invest in these loans either by mobile money or credit card or debit card, whatever. It's easier.
I see. So let's say I go on the website, I pick out 4 or 5 that I like. So you're saying, do I then add it to my basket? kind of thing? Or do I then select them, I then pay for it online?
Yeah.
How many customers use credit card or debit card to pay for things online?
So currently within Uganda, not so many, but I think a few people use debit cards, which I think currently we are still struggling with integration of our payment system with the visa system, especially because we're in Uganda. It's a third world country and visa payments are not accepted. So at some point we then rely on mobile money, especially if the amounts are typically not big. So if someone is investing the equivalent of $300, the equivalent of $3,000, yes, he can do mobile money.
Cool. So
if he's doing a little bit of higher than that, then maybe they want to do a bank transfer.
Okay. So let's say I'm a lender.
Yeah.
Can you talk me through the actual process and I say, okay, there are these 3 LPOs that I want to fund. In total, it comes to $1,000. Can you talk me through the process of how I would actually get that money to you?
Yeah. So currently, you basically register with us, open an account with us. Currently physically, but going forward, it's going to be online. So you put in all your information. We also have to do due diligence on the lender to ensure that you are a real person and not a robot. You're a person of repute and not someone from Afghanistan or something like that. Not that Afghanistan people are bad, but I'm just saying about terrorism and stuff, right? So the idea there is, to someone registers, gives us all the information about them, ID, bank statement, where they stay, location. We want to actually be sure you are a person. And then, of course, we shall sit you down and tell you about what the marketplace is all about and what the risks associated are. Whether there is a chance of gain, there is a chance of loss, what we are doing to mitigate that risk, and whether you're actually willing to actually, to do it, right? Because I want someone to come in and then say, oh, I need to understand this. I thought it was a treasury bond or something, right? So once you kind of understand the terms and you're kind of interested in doing it, then we shall allow you to place your first investments. Yeah.
And so, how does the mobile money side of thing work? So, do you have I would go to my bank. I would withdraw the cash.
Yeah. So
how does it? Can you tell me how it works?
Yeah. So currently, physically, right now, like we list the loan, we basically produce the promissory notes on paper, piece of paper right now. Then we show it to you and say, okay, this loan needs 5 million. How much do you want to put in? Maybe you say, I want to put in 1. Or this loan is $5,000. I want to put in $500. So okay, perfect. So you fill in the promissory note certificate, intending to lend $500. Then you basically, if you want to do it on bank, then you basically go and send money to a bank account. If you want to do it on mobile money, then you basically pull money from your bank account to your mobile money and send it to our mobile money account.
Cool.
Then we shall issue a receipt for that.
I see. And for those people who have not used mobile money, how does that work? So you say I get the money from my account. Do I top it up?
Most on our account. Right?
Okay.
You can simply go to a bank and do bank transfer.
Okay. Account. But just the one time I've done mobile money, is this right? So you go to like a little shop, a little kiosk, and you give that person your cash.
Yeah, that's true.
They upload it onto their phone.
Yeah.
And then from that phone, they then electronically send it to you.
Yeah, that's true.
Okay. And then is there a transaction fee involved in doing that?
Absolutely right. So for example, we've got a few people who have invested money with us when they are outside Kampala, like Eastern Uganda, Fort Portal and places like that. So typically that person will go to a shop, deposit that amount of money he wants to invest, say $500, right, which is 1.5 million, 1.3 million. So you basically go in and say, okay, I want to send 1.5 million shillings to this number. So we have a transaction account. So you basically go there, you put it, you give the person, they send the money to us. Then first we shall go to the bank and recover it. We can typically either go to another shop outside or we can just go and recover from it. We prefer to withdraw from the bank straight to the account.
And so when, so let's say it's a contract for $1,000, you've got people who have lent $1,000.
Yeah.
How do you make money?
Yeah, perfect. That's good. So typically, we do 2 things. We finance 50% of the loans we list. So if a loan needs $5,000, by the time it comes to the market, we've already committed 50% of that finance.
How do you do that?
So we have an internal fund that we have. So we use part of our own money because we want to do an investor that we are willing to take a risk on this particular entrepreneur. And we're just saying share the risk with us. So, of course, for 50% of that loan, we earn interest. But also, because other investors are investing into the same loan, we charge them standard management fee of 2% on whatever capital they invest, and then 10% of the interest they earn. Yeah.
So 10% of the upside that they get.
Yes.
So,
and then 2% of the capital.
okay. So let's say that the return is, let's say that you're charging 10%. So in theory, you're getting 1%, so you're plus 2%.
Perfect.
Whereas on the bit that you're doing, you're earning, in this case, 10%, if not 5%. Why do you not just fund all of it and earn more money?
Yeah, we would fund all of it, but of course, internally we have capital limitations. When you think about the standard structure of how a bank works, you go to a bank, you put your savings, and then the bank gets your savings and then lends it out. Right? Only that it never contacts you to tell you that we lent your money out. So, of course, any financial institution, any lending institution has to have a source of capital, where this capital is coming from. So for us, we decided to combine our equity capital with debt capital and say, okay, we shall use our equity money we have within the business to be the one that contributes 50%. And then we shall go out like the way someone would put savings and say to sell promissory notes, right? So we can't do 50% of the loan. 100% of the loan, we wouldn't have enough money to finance everything. We need a constant flow of cash inside. But Patasente to actually allow this lending to go.
I see. At any one time, what multiple of the capital you have is being lent out? Is it that you have, 10,000 liquid, 10,000 in savings, and you're lending out 10,000? Or are you lending out more than 10,000?
I think we're lending out more than what we have.
Okay.
Yes.
And is there any regulation around how much you can lend out? What multiple of the capital you have?
No,
if you wanted, could you lend out 100 times the?
Yeah, we could. If you wanted, we could actually. We just looking at how much capital we have right now and how much demand there is, and of course, currently the demand is quite high. But because we're starting this, then we have to kind of build traction and kind of trust. And actually, like when we were starting 12 months ago, people weren't willing to lend more than $500. But now you find someone lending over our platform more than 30 million, which is close to $10,000. So of course, as time goes, and we're going to be seeing a little bit of more willing lenders willing to lend over our platform. The challenge we are having that much more lenders locally want big rates. They're expecting a higher return, which means if they're expecting a higher return, you have to lend at a higher rate. But of course, as we try to become a little bit more global in terms of where we source capital, then typically we should get a little bit more cheaper capital from investors who are willing also to wait a little bit longer time. Then you can definitely offer far better values and far better rates to your final consumers.
I see. And we don't have to go into too much detail, but the people who are saving money, like the people who have deposited money with you, how does that part of the business work?
Yeah, so they don't normally. We don't get any deposits. People just lend over the platform.
Okay.
So we simply list the loan and say this needs $5,000.
But the funding that you do, you fund the 50%. 50%. And you said that is based on capital that
we have equity. Like we got an equity investor.
Oh, okay, cool. Yeah. That's it. Okay, great. So
I think we've got a little bit of a few now grant providers. So we're gonna have a little bit of much more.
So it's these investors have sort of got you started. They've kind of given you the initial.
Yeah. Okay. Initial capital, then you kind of, because we also don't normally want to lend beyond what we have. Because if we have 50% and we lend 50%, then if you have $10,000, the maximum loan amount at any typical time will be $20,000. When it increases to 20, then you can do 40. Right. So we've been trying to kind of control our growth to kind of reflect our capital value plus how much we are kind of growing from us. Kind of maintaining a debt equity ratio that's quite safe for the business, I would say.
And so we'll just do a few more questions.
Absolutely.
Yeah. So what do you see as the main challenges for you over the next sort of few years?
Yeah, I think it's in three areas actually. All areas of our business we either have to rely on a few players who are going to come in and solve them, or we have to do the work ourselves. But of course, first is payment infrastructure, right? We've got to find a seamless way to integrate mobile money, Visa, and banks seamlessly. And also see in what way can that become a little bit less costly, right? Say, if you're doing a Visa transaction, going to the bank, withdrawing that cash, then lend it out to another bank, right? So that has to be a little bit much more seamless. But within the system, money can move from the lender to our consolidated account and finally to the borrower at a very cheap cost. And of course, they can also move back because we have to pay back people using the same means. So one is for us, it's integration of payment system. For example, for lender as well in other domiciles in the USA, Europe, UK, and stuff. We have to make it very seamless for them to actually be able to place a loan to a borrower. But then secondly, on the borrower side, we have got to find a way to collect much more data and much more information that allows us to credit score them faster, right? So we are doing a lot of data collection, at least for now. Now, for example, we've been trying to place loans for farmers, right, who supply product companies like George's. Of course, if you have no prior information, how do you factor that? How do you discount that? It's kind of not easy, right? So we've got to have much more data that we are working with to allow us to grow the market quite faster. And then third, of course, from the third party who issue these LPOs, right, the market has to be much more structured. So you've got to have much more information around them to allow you to know that if, like, I would simply, as soon as you brought me a contract, I was simply placing the company name in a database and I get all the information about it, right? Now we are collecting that data from scratch, right? Which means the space of our growth, if you want to be, and we are very particular about maintaining the integrity of the business, it will be kind of limited by how much information we have about folks who are kind of delivering these LPOs. But then lastly, it's the cost of capital. But within the local market, people who are willing to lend, even if they have a little bit of more cash, want a very high rate. So if someone is expecting, say, 5% a month, that's 15% in 3 months, right? So if you're giving a loan at that rate, you have to pay a little bit higher, which makes capital very expensive to the final borrower. So ours is about, within the next few years, we've got to figure out a way to find a little bit of, expand the places from whom we are collecting borrowers, other lenders, and find lenders who are willing to lend at a little bit of a lower rate. Yeah.
And when you think some of these things might be overcome, what is there, like a long-term vision for what you do?
Yeah. Typically, really, we think Africa is a huge market, so our big goal is to make Patasente Africa's number one credit marketplace. We want it to be the place entrepreneurs who are involved in the movement of commodities in the African continent where they turn to get credit, right? So the vision is really, really big, and we think if we lay the strong foundations for it, then entrepreneurs are going to benefit from it. Of course. Yeah.
And how can people listening at home follow this journey or get involved or get in touch with you?
Absolutely. Yeah, we have a Facebook page, Patasente. We have a Twitter page, Patasente, and of course, even me personally, like if you follow me, I'm always tweeting and talking about this. Yeah.
And what does Patasente mean?
Patasente it's a combination of two words, Kiswahili and Luganda. So pata in, I think, Swahili means either get or find, depending. And then sente means money in my local language. So it was find, get, money, Patasente.
Nice.
Right.
Cool. Well, Bakka, thanks so much.
Thank you so much, Sam.
Cheers. Before we head, just a quick moment to say thank you for listening. You can see the show notes for this episode by heading to samfloy.com/podcast. That's samfloy.com/podcast. This show is still relatively new, and so I really appreciate you making it through to the end. What would be great is, if you're enjoying it, to tell a couple of your friends about it too, in case they'd also be interested in giving it a listen. Also, if you have any questions, comments or feedback, please feel free to email me, podcast@samfloy.com, and I'd be happy to chat. In any case, have a great week and speak to you soon.